Hello learners, welcome back to CA Foundation Principles and Practice of Accounting Marathon Revision Part 3 or Lecture 3. In the first part and the second part, we've done the first 4 chapters of our CA Foundation syllabus. The first video we did chapter 1 and chapter 2 other than rectification. In the second part, we did chapter 2 May unit 8, that is rectification of errors, alongside with BRS and valuation of inventories. Here we are in lecture 3 or part 3, and in this discussion we're going to do entire chapter 5 of depreciation and chapter 6 all the units starting with bills of exchange, consignment, goods and return or approval, average due date and account current. Yeah, so what are you waiting for? Let's get started with chapter 5 depreciation. And before that, an important point that you need to note is on June 15th there's going to be mega revision free test series happening on the Unacademy platform. You guys can avail that free of cost. It's going to be a 20 MCQ test for 30 minutes. You have it on other papers of law, maths and economics also on the dates respectively 18, 21st and 23rd or 2 p.m. You can avail the benefits of the same. And what's coming your way is also CA Intermediate Mega Combat Scholarship Test, which will give you huge discounts on your CA Intermediate subscriptions of Unacademy, which is very vital right after your CA Foundation examination. And you all know about the iconic program, which is the flagship model of Unacademy. It is that sort of a subscription which gives you great advantages like one-to-one live mentoring, one-to-one live doubt solving, a hard copy of the materials to be made available to you at your doorstep, sessions from industrial experts, and you also get to be part of Nord discussion channel for all your doubts. And the usual plus benefits will also be there when you get live interactive classes, recorded classes being available, one subscription giving you access to all the educators notes that will always continue to exist. And you know the prices at which you can avail the iconic subscription of Unacademy. You can get a 24-month subscription at the cost of 41,000, a 12-month subscription at 28,600, and a 6-month subscription at 20,500 rupees. And if in case you use the code YESHAS Live, which is YESHASLIVE, you get 10% off on the price that you just saw on the screen. So what are you waiting for? Download Unacademy application today from your Play Store and use the code YESHAS Live whenever you take up subscription, and follow me on Unacademy for all the updates on the courses that I launch on the Unacademy platform. So let's get started and then go ahead with the topic of depreciation. Tell me guys. Chalo, let's start with depreciation. So there are quite a lot of topics that is covered in the topic of depreciation, from which you can expect the marks on. This is a kind of file that I made in which tells about what topics are important, what topics are usually asked in the exam, and what is the weightage of each chapter in the examination. I can share this file to you people on the Telegram. If you are on the official Telegram channel, you already get that. If not, you can drop in a message to me. My name is CA Rajavardhan, and I'll definitely, if you get in touch with me, I can share this file with you what I'm using. So let's start depreciation. Depreciation is allocation of the huge cost of the asset over its useful life, and it is not an expenditure which would affect us in cash. It's a non-cash expenditure. You buy an asset today and use it for 10 years. So the expenditure that you incurred on buying the asset today will be written off over the period of 10 years. That is the useful life of the asset. That, my friends, is depreciation. Because if you don't depreciate, the asset will continue to remain at its full value over 10 years. On the 10th year, when the value of the asset becomes zero, you are forced to write the entire value to P&L of that year, which will lead to mismatch of matching concept, because the asset is used not only in the 10th year but it is used over 10 years, so it has to be written off over 10 years so that there is appropriate expense allocated in each of the 10 years P&L to arrive at correct profit. You get this? So when you allocate this over that depreciable life of the asset, useful life of the asset, that useful life is an estimate. Now when I look at an asset and then say this will last for 10 years, this will last for 5 years, that is an estimate, my friends. It's not an accounting policy. It is based on the past experience and the present situation. I analyze to tell about a figure. That is an estimate. I think in part 1 we had discussed, towards the end, last 5 minutes we have discussed what is accounting estimate, and that's coming to great use here. So depreciation is accounting estimate. Why do we depreciate, or why do we reduce the value of the asset over its useful life? Because for an obvious reason that we are going to use that asset, and when we use that asset, the economic value of that asset will decrease. It is not like an asset is like an Akshay Patra and it will produce any amount of quantity of goods and it will last forever. No, everything will have an end. Everything will have an end. There's going to be full stop at the end of the useful life of the asset also. And so every time we use it, we are decreasing its useful life and life expectancy, and that is the reason, my friends, why we depreciate the asset. First one is wear and tear. And the next thing is, though we don't use the asset, by passage of time, the utility of the product will come down because there is better technology in the market and the old technology has become obsolete and the market is changing and very volatile throughout. You got it? So market being very volatile, whether you use the product or you don't use the product, it will obviously depreciate. When you use it, it will get depreciated more. More the use, more depreciation, less the use, less depreciation. You got this? And the depreciation should be started the moment the asset is ready to be put to use. So till the time the asset is not ready to be put to use, we will not be charging depreciation. We will start depreciating the asset when the asset is ready to be put to use. Hey, what doesn't matter is, it doesn't matter whether you're using it or not. All that matters is it ready to be used? Lot of times it so happens that the asset is ready to be used, but even after it being ready for the use, organization might not start using it for whatever reasons. Maybe the day is not auspicious, or maybe the rest of the setup is not ready, or any other reason. In such a case, also we should start charging the depreciation the day asset is ready for commercial production, irrespective of the fact whether it is used for commercial production or not. There are a few important terms that you need to note in the topic of depreciation to go ahead and then compute depreciation. The first of them is cost of the asset. So what does cost of the asset mean? In the previous video, in the part 2 or lecture 2, we have discussed how to arrive at the cost of inventory. Same is the case or similar is the case in order to arrive at the cost of a fixed asset or cost of an asset. So the cost of the asset will include certain items like purchase price plus all other expenses incurred to bring the goods, to bring asset to, or all the expense incurred till the time the asset is ready to be put use. Till till the time the asset is ready to be put use. If in case there is taxes paid, we need to check if the tax is refundable in nature. Is input tax credit available on such thing? If input tax credit is available, then such tax will not be included. If input tax credit is not available, then such tax and duty will also be included. Expenses like freight inward, expenses of installation, site setup, and engineering cost, all those expenses will be included in the cost of the. None of them will be missed out. However, if there is any general administration expenses, interest expense, other than in a case where asset takes substantial period of time to be set up, all these expenses will not be included in the cost of the asset. Very similar to what we discussed in the case of inventory. Then the next thing is useful life of the asset. What do you mean by useful life? Useful life refers to such definite period of time for which the asset can be used for the purpose it was intended. Let me repeat. It is a period for which the asset can be used for the purpose it was intended. If in case a truck is being made and the truck was used for first 8 years for transportation, next 2 years with 4 stones next to the wheels to do gobi manchuri inside that, then the next 2 years wherein the truck was used as a stationary item for doing fast food, or it is being used as a fast food joint, that doesn't count in the useful life of the asset, because when the truck was made, it was not expected to be used as a food joint at a stationary level, not a moving truck, but let's say a stationary food joint. Or when a t-shirt is manufactured, what is the useful life of this t-shirt? Maybe you can say 2 years, 3 years, or 4 years. After 3 years, if I use this t-shirt for pocha, swiping the floor, and then I use it for swiping the desk, or I use it to wear on Holi, or I take the threads out of it and then like whatever nonsense you do all that. That is not included in the useful life. When the shirt was manufactured, it was intended to be like wear for it was intended for a human to wear. So till the time I'm using it to wear, it is useful life. The day I stop using it to wear and then use it for other purpose like wiping the door, wiping the floor and all, it is no more part of the useful life. Got it, guys? So useful life refers to the period for which asset will be used for the purpose it was intended. Yeah, period for which asset is used for purpose intended. Another important point that all of us need to note and then remember, here is that this useful life of an asset is an accounting estimate. It is not like an exact number. Now, will you ask the asset, what is your useful life? And asset will tell 6 years? No. You define that item as 6 years based on your past experience and your expectation or your analysis of the current situation. It is nothing exact. It is just an estimate. Got it? The next term is scrap value of the asset. What is scrap value? Scrap value is value of the asset. Maybe we can say realizable value of the asset at the end of its useful life. What is it? It is realizable value at the end of useful life. Once the useful life of the asset is over, what is the value at which you can sell it? Or how much will you realize by selling it? Yeah, realizable value at the end, not in the middle of useful life. Okay, at the end of useful life. In the middle, it is called as resale value, not scrap value. So at the end of the period for which asset can be used for the purpose it was intended, how much ever value asset can generate, that is scrap value. And this again is an accounting estimate. This again an accounting estimate. I hope you guys got this. So these three are the key important factors based on which the depreciation is computed. The cost of the value, cost of the asset minus scrap value is what we call depreciable amount, which is allocated over the useful life of the asset. So one of these changes, then the depreciation value will change. So these three are the foundation pillars based on which the entire chapter of depreciation prevails. Got it, guys? Let's get going. So there are multiple methods of depreciation. So we'll see each of it one at a time. First one is straight line method or fixed installment method. Under this method, the amount of depreciation is constant. Like you see here, see, every year the depreciation is same. It doesn't change. Amount of depreciation to be charged in each year is same. So under this method, the assumption is that the usage of the asset over its useful life is constant. Asset is used in the same pattern throughout its useful life, and that is the reason we depreciate the asset with the same value over its useful life. So what is the assumption here? We are with the assumption here that assets usage is constant over its useful life, and this is what we call as straight line method. Under straight line method, depreciation is found like this. We take depreciation as cost of the asset minus scrap value of the asset divided by the useful life of the asset. Yeah, cost minus scrap value to cost minus scrap value and divided by useful life. And this gives us the depreciation per year. And this per year depreciation is constant, doesn't change. Depreciation of year 1 is equal to that of year 2 is equal to that of year 3 is equal to year of is the equal to that of year 4 and everything. It's going to stay constant, it is not going to change. However, under written down value method, that's not how it's going to be. The depreciation is going to go with a what do you say, not a swing, you can say a slide. In the very first year, depreciation will be more. So next year may it become less. Third year may even less. Fourth year may even less. It will go on decreasing from year to year. So meaning in here, depreciation of year 1 is equal to depreciation of year 2 is equal to depreciation of year 3. That's how it's going to work with straight line method. However, under WDV method, it's going to be quite different. Here, depreciation of year 1 will be greater than depreciation of year 2. This will be greater than depreciation of year 3. and simultaneously from year on year the depreciation is going to go on decreasing because the expected usefulness of the asset is also going on decreasing. First year the value of the asset will be huge. As the year progress, the usage, the efficiency, the quality of the asset will go on decreasing or deteriorating. That is the concept behind written down value or diminishing balance. Under this method, depreciation percentage is found like this. Depreciation percentage is equal to 1 minus nth root of scrap value divided by ouch cost of the asset. This sounds a little different. Oh, I forgot to type one there. Yeah, it looks a lot better when I to say write it in the form of equation, but that's okay. I hope you guys understand. This formula, however, need not be used because they will give this formula, they will give the depreciation percentage to you in the exam. So usually what happens, depreciation percentage will all by itself be given. Depreciation percentage will be given in question. And here you apply depreciation percentage if any given on the original cost. Here depreciation is applied on the written down value. Depreciation is equal to written down value multiplied by depreciation percentage. Meaning original cost minus depreciation of last year will give you return on value. On that you apply depreciation for current year. And from the this year's opening WDV, after you charge current year depreciation, what will get is closing WDV. On this will apply the percentage to compute depreciation for next year. So percentage will be constant. The amount on which this percentage is applied will go on decreasing from year to year, leading to decrease in the amount of depreciation from year to year. And this, my friends, is return on value method of depreciation. Return on value method of depreciation is one of the most practically followed method of depreciation, which is also promoted by accounting standard for a reason that in the initial years depreciation is high and the later years depreciation will go on decreasing. On the opposite side and contrary, in the initial year repairs and maintenance expense will be less, and as time progresses repairs and maintenance will go high. And WDV method will ensure that total charge arising because of the asset on P&L is constant over its useful. Let me repeat that for you. In the initial years, in the first few years, your depreciation is high. As the time progresses, depreciation goes on decrease. And repairs and maintenance expense, initially it is less. As the time progresses, it is go on increasing. So this method of depreciation will ensure that total charge that the asset is creating on the P&L account over its useful life is constant. When depreciation is more, repairs is less. When repairs is more, depreciation is less. Got it? That's not, however, there in the other methods of depreciation. So this is one of the highly appreciated and very strongly followed practical method of depreciation. Got it? So we have questions on this also. Always need to remember the fact that depreciation is a time bound concept. The asset is used for 6 months, depreciation will be charged only for 6 months. If the asset is used for 8 months, and the depreciation is applied for 8 months. And if the asset is used for entire year, only then the depreciation is charged for the entire year. So depending upon the period for which the asset is used, depreciation is to be computed. I hope you will remember this part. Got it, guys? Then we have sum of year digits method. Under this method, the useful life of the asset is measured in terms of years, and depreciation is computed little differently. Let me tell you how the depreciation is computed under sum of year digits method. Under sum of year digits method, depreciation is computed like this. Depreciation is equal to cost minus scrap value, that is the depreciable amount, multiplied by remaining useful life at remaining useful life at beginning of the year divided by sum of year digits. This is how it's computed. Remaining useful life at the beginning of the year means, now assume the useful life of the asset is 5 years. In the first year, the remaining useful life is 5. So we'll take in the numerator 5. When you're computing second year depreciation, 1 year is over. So remaining useful life at the beginning of year 2 is 4 years. So we'll take 4 in the numerator. For the third year, 2 years are over. So remaining useful life is 3. We'll take 3 in the numerator, 2. It goes on decreasing. So proportionately it will decrease. And this concept of sum of year digits, how is this computed? This is computed by taking n into n plus 1 whole divided by 2, where n is nothing but useful life in years. We'll take useful life in years and do n into n plus 1 by 2. That becomes our denominator. And then we go on reducing 1 year from the numerator every year. Multiply this with the depreciable amount, that is cost less scrap value. Because scrap value is the amount that will be realized, or at least expected to be realized, at the end of the useful life. So we do cost minus scrap value multiplied by remaining useful life divided by sum of year digits. And that remaining useful life is at the beginning of the year. I hope you all got this. That's the third method of depreciation. Then we have production units method. Under production units method, what happens is the useful life of the asset is measured not in terms of years, but in terms of units that can be produced in the entire life of the asset. What is it? Useful life is measured in terms of units that can be produced over the entire life of the asset. Now, when you buy an asset, if you use it more, depreciation will be more. If you use it less, depreciation will be less. Now, how can you say that each of the years depreciation is determined based on is it initial year or later year? Now, for example, I buy an asset, I use it to produce 10,000 units in this year. Depreciation should be proportional to 10,000 units. Next year, if I use it to produce 15,000 units, next year's depreciation should be 1.5 times the current year depreciation. Am I right? And the year after that, if I use it only to produce 5,000 units, then the depreciation should be only 1/3 of next year's depreciation. So depreciation is something which is very much dependent upon the usage. More usage, more depreciation; less usage, less depreciation. So production units method is a right method of depreciation to be followed for a production intensive company, which basically tells that depreciation is proportional to production. Higher production, higher depreciation; lower production, lower depreciation. Am I right? Fantastic. Like you measuring the depreciation of a vehicle based on the number of kilometers it's run. It's run for more kilometers means more wear and tear, more depreciation. If it's run for less kilometers, then less wear and tear and less depreciation. Got it, guys? That's what we're going to do under this method. Under this method, depreciation is found like this. Depreciation is equal to cost minus scrap value multiplied by units produced during the year how many units has been produced during the year, and this we are going to divide by total useful life in terms of units. So we are going to divide this by units produced during the year. This is going to be divided by total useful life of the assets in terms of units. If we define the total useful life of the asset in terms of units, how many units we get? For instance, assume that the total useful life is 1 lakh units, and during the current year we used only 10,000, we produced 10,000 units. So 10,000 divided by 1 lakh, 1/10 of the depreciable amount will be our depreciation for the current year. If in case we produce 50,000 units in the subsequent year, 50% of the depreciable amount should be written off as depreciation in the next year only. So that, my friends, is production units method. This is one of the methods which is recommended under accounting standard and property, plant and equipment. And this is the method to be followed in production intensive unit. If there is any production intensive unit, they must follow this method to get the correct valuation or correct method of depreciation, or this is the most appropriate one for that kind of unit. Then we have something very similar called machinery rate method. Under this method we do something very similar, something very similar to what we did here. Useful life is measured in terms of units. No, here useful life is measured in terms of hours. Useful life is measured in terms of hours. So this is certain industries where the life of the asset can be measured in terms of hours. Yeah. Then we'll basically go by machinery rate method. Under this method, same thing what we did here. Instead, only difference is we do depreciation minus cost is equal to cost minus scrap value. In the numerator, instead of taking units produced during there, I'll take machine hours run during the year. And in the denominator, instead of taking total useful life in terms of units, I'll take machine hours, total useful life in terms of machine hours, and that will give me depreciation under machinery rates method. Got it? Yeah, you would be using this more often costing at CA interlevel and CA final level, but however works fine. Depletion method is something very similar to what we discussed under production units method, except for the fact that this is a method which is dedicatedly kept aside for wasting asset, or what we call as natural assets. So this method is used to depreciate such item. Example, mines, ores, yeah, etc. Oil mine, sorry, oil well, coal ore, gold ore, or what is it, stone quarry. For all of this, we use this method of depreciation, wherein actuary and actuarial valuation will come into picture. Otherwise, it is more of our production units method, except for the fact that here the asset once exhausted, it will not come back. It is not renewable sources of resource. That's the only point under depletion method. Otherwise, majority of it is same to same. You would get questions on preparation of ledger accounts, on computation of depreciation. There will be sale of assets, purchase of assets happening in the midpoint. So you need to remember the fact that whatever the period for which the asset is used, only to that extent you would have to charge depreciation or compute depreciation. And when you write accounting entries, there can be two primary methods of accounting: one with provision, other one is without provision. Without provision is where you straight away deduct the depreciation from the cost of the asset. You will write the entry as depreciation to asset. Under with provision, you write depreciation to provision. Instead of reducing the value of the asset, you write it as a separate liability. And that liability will be closed when the asset is sold. Done. I would always recommend you guys to do a separate working note to compute profit on law, profit on sale of asset, loss on sale of asset, or depreciation on the asset purchase in the middle of the year. Everything you do it by way of a separate working note for multiple assets, machinery 1, machinery 2, machinery 3, or motor car 1, motor car 2, motor car 3, whatever data you have. Find the total column for opening value, for total depreciation, for total profit, total loss, total book value, total closing value, everything. Once you have the total column sturdy, ready and fixed, then you open the ledger and then post those totals. That will be the easiest way to do. Many of them say, sir, don't you think doing working note will take more time? Definitely not. If you don't do working note, you would eat up same time, or in fact more time in the preparation of ledger doing working notes. And the disadvantage here is when you do the working notes along with when you try to compute the figures after starting the ledger, there is a good possibility of you going wrong, and there is a good possibility of your presentation being very bad because you don't know where to present that working. And if in case you miss out on something or you have some doubt, if you have to recheck the figures that you done, you don't even have space. Or if you don't read the question correctly and later come across one small adjustment, you will not be able to incorporate such changes into the ledger without scratching the entire problem all again. So a very strong recommendation from my end is please prepare a detailed working note for multiple varieties of or multiple assets that's available to you. Compute depreciations, profit on loss, sale of loss on sale of asset, everything separately, and only then start with the ledger account to account for the machinery or any of such assets. Got it, everyone? Fantastic. Let's go ahead and then discuss this. Come on, boys and girls. Tattantayali, answer this question for me. Change in the method of depreciation is what? Is it going to be change in accounting policy, or is it going to be change in accounting estimate? Do type in the comment section and then tell me. Yeah, majority of you would have got it right. Yeah, change in the method of depreciation is not change in accounting policy. It is change in accounting estimate. I told this to you previously also. Depreciation was an accounting policy under accounting standard 6. However, when accounting standard 6 was removed, clubbed with AS10 to revise AS10 into property, plant and equipment from fixed assets, it was changed that the fact that depreciation is no more an accounting policy, it is an accounting estimate. And how is it accounted? Whenever there is change in accounting policy, we go for retrospective method. And whenever there is change in accounting estimate, we'll always write prospectively. Prospectively means, just imagine you change the method of depreciation from SLM to WDV. You have previously last 4 years followed SLM. Now you say no, SLM is not correct, we should follow WDV. You are not going to recompute the depreciation of last 4 years. You are going to follow WDV from this year. And after charging depreciation on SLM in the previous year, whatever was the closing value, that will become the starting point on which our WDV depreciation will be computed for the rest of the fund or remaining useful life. You get this? That is prospective method. Under retrospective method, what we do is we need to go back to the year 1 of the asset and recompute the depreciation what is already charged under the older method for the previous years. That's not what we're going to do. We're only going to correct the method of depreciation and then follow the new method from the current year without making any changes to the previous year's figures. And the previous year's closing book value will be accepted as the opening book value for the current year. Got it? That, my friends, is prospective application. Whenever there is change in accounting estimate, we always give prospective effect, not retrospective. Now, method of depreciation change over. What if there is change in useful life? Initially, you expected the useful life to be 10 years. After some 3 years, it should be remaining 7 years. Then you understood, oh no, it's not 7 years anymore, it's only 5 more years. There is change. Again, it is change in accounting estimate and not change in accounting policy. And after 3 years, now assume that the asset is 1 lakh, useful life 10 years. You would write 10, 10, 10, 10 every year for 10 years, no? After 3 years, 30,000 depreciation charged. Remaining is 70 for 7 years. Then you re-estimate the remaining useful life to be not 7 years but 5 years. What you do in such cases, that 70,000 will be written off over next 5 years. 13,000 or something. That's it. 13, how much? 20 by 5. 14,000. 14,000 you'll write it to each year and then close. Got it? You don't have to go back to last 3 years and then change. No. These next remaining 5 years, you write off higher depreciation and then close it. That, my friends, is what we're going to do. And the impact that we gave or that I told right now is prospective method. What method? Prospective method, not retrospective method. Got it? And then whenever there is change in expected scrap value, you had estimated a scrap value of the asset to be some amount. No? What if that changes? That I told you, it is expected, it is not actual. Again, that is change in accounting estimate, and we're going to give prospective effect. We're not going to give retrospective effect because it is not an error that our estimation went wrong. Estimation will go wrong because it is estimation, for God's sake, it's not actual. Got it? So remember, in the topic of depreciation, everything is an estimate. Useful life, scrap value, method of depreciation, everything is estimate. And any of these 3 changes, we're going to only give prospective impact and we're never going to give retrospective. Got it? I hope you guys did. Hello guys, let's get going. We'll now go to the next part, revaluation. At any point of time, if the organization feels that the value of the property, plant and equipment is not right, it is either overvalued or it is undervalued, then accounting standard and property, plant and equipment allows the organization to revalue the asset to the value that they think it's suitable. In fact, at regular intervals, they need to check if the value is correct or not and then revalue. Whenever you do revaluation, there are 2 sorts of revaluation possible. The revaluation can be upward or revaluation can be downward. The revaluation can be upward or revaluation can be downward. Whenever the revaluation of the asset is upward, we will transfer such an amount to revaluation reserve. Where do we transfer it? Whenever it is downward, we write it off to P&L account as expense or loss. However, if it is reversal of the previous upward or if it is reversal of the previous downward, we will reverse whatever was done in the past to the extent it's available. Beyond that, any upward revaluation or upward revaluation of the asset or positive revaluation, increase in the value, will be returned to revaluation reserve, and any downward revaluation will be debited to P&L. Got it? You will read this in detail in AS10 when you come to CA Inter. Right now, what I told you is more than sufficient. You can follow only this one. One moment. The next part is with regard to provision for depreciation. I was mentioning it these two people in the past, saying that how do we depreciate the asset? We depreciate the asset by writing the journal entry as depreciation account debit to asset. This decrease in the asset, no, there is no part of the asset going out. Yeah, then how can you credit asset if there is no part of the asset going out? The decrease in the value of the asset is notional, estimated, expected, not actual. The asset is there with you, no, completely. So to justify this, no, we will not write it to asset account. We'll write it to provision for depreciation account. Instead of deducting from the value of the asset, we maintain it as a separate provision. This is maintained till the time the asset is removed or scrapped or sold. The moment the asset is sold or scrapped, we transfer this provision for depreciation to asset to bring the asset down to its book value. Done. So there are a few questions wherein there is a requirement for preparation of provision for depreciation account along with disposal account. So I would strongly recommend you to solve a problem or two on disposal accounting. I've in fact put a few questions on our special class platform on disposal accounting. If you can get in touch with me, I can share the links for the same. And you must practice questions on provision for depreciation account and disposal account. Nothing very difficult. The same profit or loss on sale of the asset what you compute, no, it will be identified by transferring original cost of the asset, accumulated depreciation of the asset, and the sale consideration of the asset to disposal. Usually when you sell the asset, you write the journal entry bank account debit to asset account. Bank balance is increasing debit, asset is going out credit. Difference will be profit or loss. However, if there is accumulated depreciation, we'll write bank account debit, provision for depreciation debit to asset account. Difference is profit or loss. Why do we debit provision for discount, provision for depreciation? It is previously credited and that liability provision is existing on the asset which is sold. So once the asset is sold, that provision is no longer required. So we debit it to close it. Or we debit it so that we can reduce the original cost to the extent of WDV to WDV so that WDV can be compared to selling price to find profit or loss. When we follow disposal account, what we do is we don't do this sale consideration to be written in asset account. If not for disposal account, usually we write the sale consideration received in asset account credit side. In this case, what you do is original cost of the asset is transferred from asset account to disposal account. Provision for depreciation on the asset sold will be transferred from provision for depreciation account to disposal account. Sale consideration will also be written to disposal account. And in the disposal account, we'll find the profit or loss on sale of the asset as balance and figure. In fact, disposal account is not the difficult part. Disposal account makes it very simple, makes it very easy for you to understand how exactly is the profit or loss arising on the sale of an asset. Yeah, so that is one part which I would recommend you people to practice few problems on. Yeah, and you would be through with the topic of depreciation, one of the most beautiful chapters, easy chapters, and chapter which wherein you can very rarely go wrong. So a must do chapters in your CA foundation examination preparation is the topic of depreciation. I hope you'll all do this. Now we are done with chapter 5. Let's now venture into our chapter 6 and we'll start with the first unit in chapter 6, that is bills of exchange. Shall we? There we go. Chapter 6, Unit 1, which talks about bills of exchange. Shall we start with bills of exchange topic? And before even I start with this chapter of bills of exchange, an important pro tip that I'm giving all of you, which I would not recommend, but I would force you people to follow, is whenever you do the revision or first time reading or whatever you do, always finish the topic of bills of exchange and then go to do the topic of average unit account current. Majority of the students know they start with average unit account current because it is easier to. But tell me, friends, whenever you do average unit account current, how do you find due date? How do you find maturity date? What is the concept of holiday, known holiday, and how do you get all that? All that is from the chapter of bills of exchange, no? So if you don't do bills of exchange, you do average and then come here, isn't it like you are doing little bit of bills of exchange there? So instead, do formally bills of exchange, understand everything in detail of bills of exchange, then do average due account. So my very important requirement that I am sharing it with all of you people in your exam preparation is, please do finish the topic of average due date account current first, and then do, sorry, please do finish the topic of bills of exchange first and then do average due date account current. Got it? Yes. So let's get started. What and all is to be learned from this chapter? This is the expansion, or this is the demo copy of a bill of exchange. Now, what exactly is a bill of exchange? Bill of exchange is an unconditional order made by the seller, accepted by the buyer, for payment of a money that is due on a pre-agreed date or at the end of a pre-agreed period. Got it? To the person or is order, to person holding the bill or is order. That, my friends, is what we mean when we say bills of exchange. You know it, no? I sell the goods to somebody, so that person is supposed to pay me money. So I draw this bill, give it to him, he will sign it and then give it back to me, and I'll hold this bill. He is supposed to pay me money on the date that we agreed upon in the bill, or at the end of the period that we agreed upon during the period, and he is supposed to pay me or the person whom I order him to pay. That is a bill of exchange. And me, who makes the bill, I am a drawer. I give the bill to him, he accepts it. He is a draw. He is calling the bill from me. He is receiving the bill. Person who is calling the bill is drawee. Person who is giving the bill is drawer. I am a drawer. He is a drawee, and he gives the bill to me. I'll keep it with me. He is supposed to pay me money. He is a payer. I am a payee. You got this? Very good. That's the concept of this. So parties involved are drawer, drawee. I am drawer, seller. He is drawee, buyer. He is supposed to pay money. He is payer. I am supposed to receive money. I am payee. Got it? So there are a lot of important terms. Number one is date of drawing. What do you mean by date of drawing? Date of drawing refers to the date on which I draw this bill on him. Date on which I draw this bill on him. Date of acceptance is the date on which he accepts the bill that I drew. I drew the bill on him, say on 9th of June. 9th of June is the date of drawing. He accepts the bill. He signs the bill on 10th of June. So date of acceptance is 10th of June. But what is bill date? Meaning, from what date does the bill period starts counting? That's a very important question. So the bill date starts counting from the date on which either of us decide to start counting. How is it? It depends upon the type of the bill. There are several types of the bill. That is bill after date, bill after site, bill on site, bill on demand. If it is bill after date, what does this bill after date mean? Bill after date means bill period starts from date of drawing. However, bill after site means bill period starts from date of acceptance. Here bill period starts from date of acceptance. However, if it is bill on site or bill on demand, the bill matures. Drawer asks for money. There is no concept of bill period. The drawee should pay money to me whenever I ask for money. Bill matures when drawer asks or drawer demands. So till the time we're in good terms, it's good, bro. The day I ask for money, you should pay. There is no concept of bill period. There is no concept of due date, maturity date, pre-agree. Nah. The day I ask, you should give. The day I present the bill, you should give. It's also called as bill on presentment. Bill on presentment is also same thing. So whenever they say bill after date, you start counting the bill period from the date of the bill. Oh, sorry, from the date of drawing. However, if it is bill after site, you start counting from date of acceptance. If it is bill on site, bill on presentment, bill on demand, then maturity date is date on which the drawer asks for money. Means the date on which the seller asks for money. Got it? So now you understood, or so far you guys have understood what is date of drawing, what is date of acceptance, what is bill date. Now what is due date? Due date is bill date plus bill period. This bill date, what I'm telling here, can be date of drawing or can be date of acceptance. Depends upon whether it is bill on site or bill after date or bill after site. If it is bill after date, then you start counting from date of drawing. If it is bill after site, you start counting from date of acceptance. So that you add bill period. Bill period can be 20 days, 30 days, 1 month, 2 months, 3 months, any of this. So we add such period. When we add such period is when we arrive at the due date. And then the maturity date will be usually due date plus 3 grace days. To the due date, if we add 3 grace days, we will arrive at maturity date. However, in certain cases, due date and maturity date can be same. Yes. Can due date and maturity date be same? Yes. Due date is equal to maturity date. When will due date and maturity date be same? The scenarios when due date and maturity date will be same is when we actually give in detail that there is no concept of bill period. Yeah, I mentioned in my bill that the bill is going to mature on 1st of August. The bill is going to mature on 1st of August. There is nothing like due date is 1st of August, maturity date is 3 days after 1st of August. No such concept. It's going to be 1st of August always. 3 grace days will come in only when I mention certain period. If I mention bill period is 1 month, so from the date of the bill, 1 month may we get due date and then 3 days grace is given and then there is maturity. If the maturity date is pre-agreed, mentioned in the bill, or even if it is bill on site, bill on demand, then due date is maturity date. Both are same. No concept of 3 grace days. Isn't it? Yes. Sir, when will 3 grace days concept come? When do we add 3 grace days? When bill is for a specific period. In the bill, no, we don't mention the due date or maturity date. In the bill that I drew on my customer, I would write bill will mature after 3 months, after 1 month, after 60 days. If I mention such period, then I would be adding 3 grace days to due date to arrive at maturity. If not, then no. Got it? Then we have what if maturity date falls on a holiday. Depends upon the type of the holiday. Depends upon the type of holiday. If it is known holiday, then previous day. If it is unknown holiday, then it's going to be next, not next day, next working day. What if next day is holiday? So we usually go by next working day. Important. Remember this. So if it is a known holiday, then the previous day. If it is an unknown holiday, then the next working day. This is for maturity date, not for due date. If the due date falls on a holiday, then that itself will be the due date. There is no change or no harm. If it is maturity date falling on a holiday, then we would have to see is it a known holiday or an unknown holiday. If it is a known holiday, then the previous day will be the maturity date. If it is an unknown holiday, then the next working day. What are known holidays? Known holidays are like this. Right? Known holidays. It is 15th August, 26th January, 1st April, 30th September, and all Sundays. Sir, Christmas, Gandhi Jayanti, Mahavir Jayanti, Kanakdas Jayanti, Basava Jayanti, Mahalaya Amavasa, Ramzan, all those are not counted. What's counted is only these 5 holidays. Only these 5 holidays are considered as known holidays. If any other days, there are also known holidays. You know very well in advance what day is Mahashivratri, what day is Ganesh Chaturthi, what day is Eid Milad, what day is Good Friday. You know it in before. But with regard to examination, only these 5 are known holidays. If it is any other holiday, they should mention that day in the question and they should mention that that day is holiday. Sir, no sir, I know sir, September 10th is Ganesh Chaturthi. It is okay if you know it. Have they told in the question that that day is so and so holiday? If they tell in the question, only then you take the previous day. Don't take it if not that. And Sundays also. Sir, I am very sure, sir. I know very clearly that that day is Sunday. That day only it came. I'll take previous. Don't take. They will tell in the question that it is a Sunday. Only then you take. If they don't tell, don't take. You guys get it? So there are only 5 known holidays. for the exam purpose. 15th August, Independence Day. 26th of January, Republic Day. 1st of April, opening of financial year. 30th of September, half yearly closing, and all the Sundays. If it falls on any of these days, the maturity date falls on any of these days, then the day previous to this day, before this day, will become our maturity date. Like if the maturity date falls on 15th of August, 14th of August is maturity. Sir, if 14th of August is Sunday, then 13th of August. Sir, 13th of August is unknown holiday, then next working day, that is 16th. Sir, 16th is again Sunday. Hey, how many Sundays will come in 2-3 days gap? 14th itself is told Sunday, no? Then how can 16th be again Sunday? Sunday to Sunday only one day gap, huh? No, right? Then 16th of August will pretty obviously be Tuesday. That day will be there. If in case if it is again some holiday, next working day is the topic. What does it say? It says very clearly that we should go for next working day. I hope you guys understood. The same concept what we learned now will be applying in the topic of average period in account current. Got it, my friends? Fantastic. Then we're going to account for the same. Then there is another negotiable instrument, what is called as promissory note. Promissory note is not an unconditional order. Bills of exchange is an unconditional order, meaning if I am the seller and there is a buyer, after I sell the goods to him, I unconditionally order him to sign. Meaning unconditional means he can't change any of the terms in the bill. He can't change the date, he can't change the period, he can't change the amount, nothing. He should only sign. Only sign. That is a bill of exchange. You get this? Now with regard to promissory note, I am going to order him, hey, you would have to sign. He said, no, don't make me order. I will only make a promise. So when I am the seller and selling goods, I won't draft the document. The buyer himself takes one paper and he'll write, I promise to pay you rupees 10,000 on 13th of August. He will only write, sign and then give it to me. So he is making a promise to pay the holder of the document, not the holder, the recipient or the person whose name is mentioned on the date mentioned. That is a promissory note. With regard to promissory note, the person making the document is called maker or promisor. In our case, the buyer is the maker or the promisor. Seller, me, is promisee. I am receiving the promise what he is making. I am the promisee. And that maker or buyer is the payer. He is going to pay money. I am payee. I am receiving money. So the buyer is the maker, is the promisor, is the payer. I am the seller, the promisee, and the payee. Previously, with regard to bills of exchange, I told that it should be paid to the person or his order, meaning it should be paid to me. The buyer has to pay money to me or the person to whom I order my seller to pay. That's not going to happen in the case of promissory note. Promissory note is not a negotiable instrument. It is going to be a registered document, meaning the name to whom this promise is made will be written. Promise is not transferable. He has made the promise to me, is going to pay me only. I can't say pay this to my friend. No, only I can collect it. Nobody else can. It cannot be transferred. The promise what I have received from my buyer cannot be promised to another person. That's the beauty of promissory note. The reason is only person, and section 31E of RBI Act says that no person other than RBI can issue bearer promissory note. You can only give registered promissory note. Why is it that we can't give promissory note? Because in India, the currency note is a bearer promissory note. If you see there, it will be written on the currency note. Every damn currency note has this text. I promise to pay the bearer of this note the worth of rupees 100, signed by RBI government. That's a bearer promissory note. If I hold that document, I will get 100 rupees worth value. If you hold it, you get it. So whoever holds is the owner of it. You get the same? So that is a bearer promissory note. In our country, the currency note is a promissory note. Fiat currency, however, there is no gold backing, but it is what? It's a bearer promissory note. So bearer promissory note, if I also start issuing, instead of RBI signature, I will put everywhere. I'll go buy one packet of milk. I'll give one bearer promissory. He will give it to the seller from whom he buys the milk. Can you do that? No. In our country only, you have to give a registered promissory note. You can't give a bearer promissory. Got it, guys? Fantastic. By this, we are done with the topic of promissory note. Let's get into the parties note. I told you, no, seller, promisee, payee, buyer, promisor, payer. Got it? Fantastic. Now the options with the drawer. I am the person who drew the bill. No? What options do you have? I have three options. I can hold the bill till the maturity date, or I can discount it with the banker for immediately. I'll give it to the banker, banker will immediately give me cash after deducting some portion towards the charges. Or I can endorse it to another person. Now, if I hold it till the maturity date, only I, drawer and drawee, only both of us are involved. If I discount it with the banker, three of them are involved. I, that is drawer, drawee, the one who is supposed to pay money, and the banker. Banker, because I have given the bill to banker and I have collected some money from the banker after he deducts his charges. On the maturity date, the banker will collect the money from drawee. If the banker gets the money from drawee, it is called honoring of the bill. If the drawee fails to pay money to the banker, banker will throw the bill back to me and I would have to pay the bank. Done. And endorsement is, I have sold goods to somebody, so I raise a bill of exchange, my customer accepts, I keep it with me. Similarly, I have purchased goods from my supplier to whom I am supposed to pay money. Instead of he raising a bill on me and I accepting that bill, I give the bill what my customer has given me to my supplier and pay the balance to him in cash or something, or however, and I'll ask my supplier to collect the money straight away from my customer. If my supplier collects the money from customer and my customer pays money to supplier, all good. If the customer fails to pay money to supplier, supplier will come back to me as dishonor of the bill. I would have to give him money, and holding this bill, I have to collect money from my customer, and I would have to collect dishonoring, all those entries will come. Got it, guys? Then that's it. You need to do a lot of problems and then lot of entries based on this case. And once you practice the entries on this, no, we'll be done with this topic. I can quickly try and show you how the accounting entries are done in this case. Give me a moment. I have few set of entries written in the regular batch. I can show you that file. That will become way too smooth. I can share this file also with you people at a later stage when you are interested. This is all the computation. Yeah, these are the options with the drawer. If he holds it till maturity, when the drawer or the seller, yeah, when the goods were sold, he'll write the entry drawee to sales and drawee will write purchase to drawer. When the bill is received, he'll write bills receivable, asset received to drawee. He'll write it's a liability to drawee. So he'll write bills payable credit, drawer debit. On the maturity date, if the money is collected, you will write cash account debit to bills receivable because money is collected against the bill. And drawee will write bills payable to cash because he has paid money against the bill. If the bill is dishonored, then this guy will write noting charges. You would have to pay some charges proving that the drawee failed to pay, and this is notarized by notary public and you'd have to pay them certain charges. This will be given to the court of law as an evidence to collect money from them. So this one last attempt or one last chance given to the drawee to pay. If it doesn't pay, then I'm going to return the bill to him. My asset is going to decrease and that noting charges is not my expense. I'm going to credit that also and I'm going to collect the total money from drawee, that is bill amount plus noting charge. It is receivable from drawee, so I'll debit his account. On the other hand, drawee liability bills payable is decreasing, debit. Noting charges is expense increasing, debit. Totally drawee now should pay the drawer amount, bill amount plus noting charges amount. That's what is going to credit, and that's how we're going to write the entry. Noting charges being expense, it's transferred to P&L to noting charge. This is the entries in the books of drawer and drawee for a bill of exchange if it is held till maturity. Then let's see what are the entries if the bill is discounted with the bank. Yeah, like I mentioned previously, drawer wants money immediately and he can't wait till maturity date. So he goes to the banker and seeks money from banker for bills receivable. Banker will deduct a certain percentage of it towards his charges and the balance will be paid. Got it? So here entries are same, sale entry is same, and then bill accepted entry is same. The important part that we need to note here is the discounting entry. As a drawer holding the bill, if I go to the banker and then discount the bill, banker will give me money. So will debit bank account. Further, banker will not give me entire money. If the bill is of 10, he might give me 9,500. The remaining 500 what the banker doesn't give, but against which I will still give him the bill, is my discounting charges. Such discounting charges again I am going to debit here. Credit will be given to bills receivable account. So the journal entry that I am going to pass is bank account debit discounting charges account debit to bills receivable account. There's going to be no entry in the books of drawer because he's not involved, and banker books I've just given it here, but however it's not questioned in the exam. Exam mein they only ask from drawer and drawee perspective. So this was for knowledge perspective and detailed understanding perspective that I did in the class, which you can completely ignore right now. Yeah, because we're on the verge of exam now. Yeah, then let's go on the maturity date. If the banker collects the money from the drawee and drawee honors the bill, if it is honored, we write no entry. Why? Banker has collected money from drawee has paid money to banker. I am drawer, I am not involved. However, drawee will write the entry bills payable to cash. To him, it doesn't matter whether it is banker or drawer. He paid the bill, he tore the bill over. If it is dishonored, then the banker will give the bill back to us. We'll receive the bill and we'll pay the money to banker. Bills receivable to bank. We will not keep this bill with us any longer. We would pass it on to our drawee. So we'll write drawee account debit to bills receivable account. If we have incurred any noting charges, we'll write noting charges to cash and then credit that noting charges, trying to recover the same from drawee, debiting our drawee account with bills amount plus the noting charges amount. And drawee is going to credit the drawer account with bill amount plus noting charges because he needs to pay us the bill amount and the noting charge. And his bills payable is returned to him, liability decrease, and noting charges a new expense to him. He is going to transfer this noting charges to P&L and he should next pay this amount. If he pays it in full, good. If he doesn't pay, to the extent he doesn't pay, it will become bad. I hope you guys understood this. Let us now move on to the third scenario that is there with the drawer, that is endorsing of the bill. In this case, we need to learn accounting from all the three perspectives. Yeah. So he is the supplier or endorsee or payee. Now I am there. I am the the drawer. I have a customer who's drawee. I sell goods to him. Then we'll write the entry drawee account debit to sales. He purchases goods from me, so we will write the entry purchase account to draw. To sell these goods to my customer, I have previously purchased goods from my supplier. From my supplier, when I buy goods, I will write the entry purchase account debit to supplier, and my supplier will write the entry drawer account debit to sales. Done. And my customer will give me bill, for which I will write the entry bills receivable account debit to drawee account. And my customer will write the entry drawer account debit to bills payable. And this bill what I received from my customer, I will pass it to my supplier. When I pass it on to my supplier, he is called as endorsee. I am called as endorser, and what I did right now is endorsement. In the process of endorsement, I am giving endorser. He is equaling the document, so he is endorsing. Got it, guys? So this bills receivable of mine, what is there with me here as a debit, I am going to credit it and debit my supplier account. He is going to debit bills receivable and credit my account. And my customer will pass no entry because he is least bothered about this. It is transaction between me and my supplier, and my customer is not involved. On the maturity date, my supplier will go to my customer, and if my customer pays money to my supplier, Ram Ram, I am not going to pass any entry. Got it? See here, on the maturity date, if honored, I will not pass entry. My supplier will write the entry cash to bills receivable because he receives. My customer will write bills payable to cash because he pays the money. If in case it is dishonored, my supplier will come back to me and give the bill back to me. So I am going to receive the bill. Got it? I will write the entry bills receivable account debit, noting charges account debit to supplier. I am going to give him the bill money, noting charges money together. Credit, bill amount plus noting charge. I am not going to keep it with me. I am going to give it back to my customer. Bills payable account debit, noting charges. Drawee account debit to bills receivable to noting charges. He should pay me bill amount plus noting charges. For which he will write a reciprocal entry. Bills payable debit, noting charges debit to drawer account. That is me. And he will transfer this noting charges to me. Got it? So it's just that reciprocal things that's happening throughout here which you need to be cautious about. For sure, definitely they'll not ask accounting in all the 3 persons books. They'll ask in 2 persons books or maybe 1 person's book, which if you are a little cautious about, you can definitely ace it in the exam. One of the easiest topics to do. Yes, there are little tricky parts in this chapter, that is accommodation of the bill. I'll explain that little later after I explain retirement and renewal to you. But trust me, with little bit of practice, not a difficult topic, very easy and less time consuming in the exam, considering the fact that this doesn't have too many ledgers, simple journal entries. And usually the marking schema is such that each journal entry will definitely fetch you minimum of 1.5 to 2 marks. So you can say a good chapter to be scoring marks at. Done? Yeah, let's go to the next one. Settlement of the bill. Now we have pre-agreed upon the bill period which will take us to a maturity date. or a due date, or we have pre-agreed the due date or maturity date also. So the settlement has to happen on that day. However, on mutual agreement, I and my drawee can agree to settle the bill before the maturity date or after the maturity date, but not on the maturity date. If we agree to settle it before maturity date, he is willing to pay, I am willing to receive, it is called retirement of the bill. It is called retirement. It's like you stop working even before you die. That is retirement. You die at the age of 75, 80, you stop working at the age of 60. So for those 15 years, all you're doing is waiting for death to come to you. That is like retirement. The bill is dying before the maturity date. That is retirement of the bill. So the bill is settled before maturity date. The bill is settled before maturity date. So if the bill is settled before maturity date, drawee is paying me money before maturity date. I am collecting the money before maturity date. Am I happy? Absolutely happy, because I am receiving money before the maturity date. So what would I have to do? I would have to keep the drawee happy. How would I keep him happy? I would give him discount. I would give him rebate. Enjoy. You paying me before and making me happy. I'd also give a discount. It is given as a percentage of the bill amount for the period that is settling before the maturity. You get this? See, discount is computed as bill amount multiplied by period before the maturity date that is settled multiplied by discount percentage. This is expense to me, income to him. Because it is expense to me, I am going to write it to discount allowed account. Because it is income to him, is going to credit discount received account. I am going to receive money, I'll write cash account debit, not full money. Some money is discount allowed, I'll debit discount allowed as expense, and credit bills receivable, because that bills receivable is going to be told and settled. However, in this case, is paying money, his liability will decrease, bills payable debit. Is receiving discount, it is his income, discount received credit. Is paying money, his cash is decreasing, cash account credit. I hope you guys are getting the real feeler that this is a marathon, considering the fact that we're doing it at a very quick pace. You're not skipping concepts, but doing it fast. I think usually you people, when you watch few lectures, you keep the lecture speed at 1.25 speed, 1.5 speed, 1.75 speed, and then watch. However, it's a very funny joke what one of the students told me. Sir, we do this for other lectures, that we keep the speed at 1.25, 1.5, 1.75. In other case, in your class, we keep the speed to 0.75, 0.5 and then listen, because you are faster than usual. So I took it as a compliment. I don't know if it was if you are trying to offend me. But whoever told that, thank you guys. Compliment accepted. I'm like flash. I'm running. You guys are not able to see. That's it. So let's get going. Next, settlement of the bill after the maturity date. Sometimes the drawee doesn't have the money to pay me the money on the maturity date. In such a case, he would say that, hey, can I pay later, after maturity date? I will say, okay, pay me after. Then I am getting the money late, no? So I am unhappy. No, he has the responsibility to make me happy. So he would pay me extra money called as interest. This interest is paid as a percentage of the bill amount for the period of delay. So interest is computed as bill amount multiplied by period multiplied by interest percent. This is income to me and it is expense to him. It is income to me and it is expense to him. So I would be crediting interest account. He would be debiting interest account. So I will write drawee account debit is supposed to pay me not just for the bill amount but also for the interest. So I will debit drawee account for bill amount plus interest amount. Interest amount being income, bills receivable credit because it is decreasing. On the other hand, drawee will write bills payable account debit because his liability is decreasing, and debit interest because it is expense, and total money he owes me. So he is going to write it to that account. Got it? Fantastic. If the drawee doesn't pay the money, if the drawee doesn't have the money to pay, then that's what we call as insolvency, which will lead to bad debts. In my books, I'll record it as bad debts as an expense. In his books, he'll record it as deficiency, which is credited and looks like income, but it is not income. Got it? So now I'm supposed to receive money. Assume that I'm supposed to receive 10,000 rupees from him. If I receive 6,000, I'll write cash account debit 6,000, that is amount recovered. To the extent amount is not recovered, it is debt that has turned bad, I'll debit bad debt account. Credit my drawee with total of 10,000. On the other hand, my drawee will write cash account credit, whatever he paid, 6,000. 4,000 that he didn't pay is going to write it as deficiency account and is going to settle my debt of 10,000. Got it, guys? So this is the entry that we're going to write for if Droid doesn't have the money to pay. So we covered this concept. Last concept that we have to learn in this chapter. This is the notes from our regular batch. We've done hell lot of questions and detailed, and this is one fat Excel file for all the topics together. You name the chapter: rectification of errors, BRS, valuation of inventories, depreciation, bills of exchange, goods, and everything is there in one Excel sheet. So even if in case the student who has attended this batch lost his notes, he just have to ask me for once, and I'll share the link of this Excel sheet. He has all the chapters, entire theory, all the chapters, solution to all the questions with him. And best thing is you can search. You do Control F and then type the amount. All the questions which has solution with relating to that amount will be popping out. So it's very easy to access for a student. So I did this from the last batch to help students easily revise. Done. And if in case I give certain questions as homework, I can update the answer right here in the Excel sheet. This sheet is synced to Google Drive, and then the answer will be available to them later stage. So they can compare their answers very easily. The other concept is bill sent for collection. So it's like a service where you will write bills sent for collection, account debit to receivable account. When it is collected, we'll write bank to bills for collection. If it is dishonored, we'll write draw to bills for collection. This is a very small concept. Questions have been so far not asked on this, but theory mate is covered. You guys can revise it. Here comes the last part of this unit. Yeah, I think we are running out of time. Are we in this video? Yes, we are. That's fine. Let's quickly revise this. Accommodation of a bill. Yeah, you want money and you go to a friend to ask it. Your friend says even he doesn't have money and even he is searching for money. Then what both of you do is you both come out with a beautiful financial plan wherein you will raise a bill on your friend, though he doesn't have to pay money to you. He accepts the bill. You take that bill to the banker, get it discounted, and whatever discounted proceeds you receive, both of you share. Along with discounted proceeds will also be shared. Expenses, discounting charges will also be shared. On the maturity date, when the banker goes to your friend, asks for money, he doesn't have to pay the entire maturity amount. That also you will share. Everything in the same ratio. So this is a financial adjustment wherein you raise a bill on each other and then you get it discounted and share the discounted proceeds in a pre-agreed ratio. This is the same ratio in which discounted proceeds, discounting expenses or discounting charges, and the maturity proceeds to be repaid to the banker will be shared. A beautiful topic. This is called as accommodation of bill. The problems becomes interesting when the money is not paid by one of the person on the maturity date and the bill is dishonored. Banker goes back to the original person and the original person has to pay money. A very interesting thing that you guys can definitely try and do problems on. Please solve few problems on this accommodation of bill. I've covered few in the fast track revision also in the past, which you guys can access and then see. And that we'll by that we could say that we have successfully completed the topic of philosophy. In fact, this is the most tricky part of the chapter. As I've told you previously, the time doesn't help me. I initially planned this to be about 5 hours of lecture, but as a precautionary measure, when I started communicating to you, I told it's going to be between 5 to 6 hours. Now, looking at the way it's going when I'm taking the class, it's definitely going to cross 6 hours. This marathon revision because of the volume. 6 hours is very small time to complete the syllabus. If you guys can understand. If I start doing problem, I can only do one problem in each of the topics, and that too not the best of the problem and not covering all the concepts. You have done all the conceptual, you've done all the problem practice all these days. Now I'm just a week before the exam, I'm giving you conceptual coverage so that after this you can again go back to do one problem on the same. And if you had any teeny tiny conceptual doubts, that will get solved in this particular lecture. Is the entire objective about it. And by this we finish our first unit of chapter 6. I initially in the beginning of the video I told we're going to do entire chapter 6, but we're surely not able to. I've crossed the time limit as well. So let's take a pause here at this video. So this is the end of part 3 or lecture 3 of your CA Foundation Principles and Practice of Accounting revision, you can say. I'll come about with the next video, part 4, or what do you say, lecture 4, in which we will do the remaining units of chapter 6, that is goods sent on return or approval, average due date, account current, and consignment also, and then start with final accounts. Maybe we might make this 5-part video to 6 parts or something. Let's see how will it go. Like, I'll do the right justice to the revision that it requires to be done with. Got it, guys? I hope you understood the topics that we discussed in this video, that is of depreciation and bills of exchange. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you guys are learning something, you're having fun, it's all good. The day you guys either stop learning something or stop having fun, trust me, you might start struggling because you might be. So thumb rule to stay happy is pretty simple. It is to stay in the game. For one last time on this day, I have just one simple question to all of you. Are we in the game? I hope the answer is yes. Please do like, share, comment on this video and then subscribe to the YouTube channel for more such updates. You can also request me for the topics on which you want me to do videos in the future. And see you in the part 4 of CA Foundation Marathon Revision. Till then, stay in the game and